Hello, and welcome to Morningstar's second quarter 2025 U.S. stock market outlook. My name is Susan Javinsky, and I'm an investment specialist with Morningstar.com and co-host of the Morning Filter podcast. Now, if there's one thing that's certain about investing in 2025, it's that uncertainty has reached a fevered pitch. Uncertainty around tariffs, inflation, the economy, and artificial intelligence has led investors to sell risk-on assets in favor of risk-off investments. 2025 has been a good reminder of the value of diversification. Here to share their second quarter outlooks for the stock market and the economy are Dave Sequeira, Chief U.S. Market Strategist with Morningstar Research Services, and Preston Caldwell, Chief U.S. Economist with Morningstar Research Services. And this quarter, we're joined by Morningstar Europe's Chief Market Strategist, Michael Field, who will share his forecast for Europe's markets. Now, before we begin today's conversation, we want to take a minute to make sure you get the most from our presentation. Today's webinar will be recorded and available on demand after the live session. All registrants will be emailed a link to the playback following the presentation. Lastly, you can ask Dave, Preston, and Michael any questions you'd like using the question button. And after the presentation, we'll address as many questions as we can get to. So let's begin. Dave, over to you.
All right. Thank you, everyone, for joining us, and thank you, Susan, for that introduction. As always, I'm just going to provide our overview for the U.S. equity market outlook for the second quarter. I'll then pass the baton off to Preston, who will then update us on his recently revised U.S. economic outlook. And as Susan mentioned, we've got a special guest star today. We've got Michael Field, who's joining us from Europe to provide an overview of the European market outlook and a bit of a teaser for his webinar in the next couple of days as well. So with that, let's just take a look at where we are today. So first of all, I just have to note these numbers are going to be different than what you may have seen in the second quarter outlook that we published at the end of March. At that point in time, we had used data as of March 24th in order to come up with our outlook. Needless to say, the market has changed quite a bit since then. So yesterday, I updated all of our slides using data as of close of trading on April 4th, last Friday. So coming into this week, we are trading at a 17% discount to a composite of our fair values. And as a reminder, or maybe for those of you that haven't joined our webinar in the past, just a little synopsis on how we look at the markets. Many other strategists usually start off with a top-down approach in order to come up with a valuation for the market. Oftentimes they have some sort of model, some sort of algorithm to come up with S&P 500 earnings that they expect for the year, and then they'll apply a forward multiple to that. I always find that to be a little bit of an exercise in goal seeking. Seems like for the most part, they're usually always saying the market's 8 to 10% undervalued. We actually do the exact opposite. We cover well over 700 stocks that trade on U.S. exchanges. And then we'll take a composite of the intrinsic valuations of all of those companies, the fair values as assigned by our equity analyst team, and we'll compare that to a composite of the market price. And that's how we come up with that price to fair value composite. And when we take a look at these fair value composites, break it down by the Morningstar style box, I'd note that value stocks still remain the most attractive part of the market. We still recommend investors staying overweight value stocks. That has been our recommendation all year. And then looking at core stocks and growth stocks, and as you'll see in a couple more slides, growth stocks were the ones that got hammered the most thus far this year. They're now starting to look a little bit more attractive than they did at the beginning of the year. So I think this is a good time now to start moving into more of a market weight position in growth stocks as opposed to our prior recommendation, which was underweight. And core stocks, we started off the year as a market weight position. They did outperform growth stocks to the downside, but looking at valuations being a little bit higher than growth, I think now is a good time to start moving into an underweight position in core stocks. Looking at the valuations by capitalization, I'd note that small cap stocks still remain the most attractive part of the marketplace, trading at a 29% discount to fair value. Our recommendation at the beginning of the year was to be overweight small cap stocks. We're still holding that recommendation to an overweight there. Mid-cap stocks looking attractive, but on a relative value basis, being the more expensive part of the capital structure. So I would move into more of an underweight position in mid-cap. We started in a market weight position at the beginning of the year. And then lastly, looking at large cap stocks, I think now is a good time to start moving from that underweight position that we recommended at the beginning of the year to more of a market weight position today. Now, people always ask, how has our price to fair value, worked out over time? So you can see at the beginning of the year, in 2025, as we came into the year, we started at what I would call a rarely seen premium, over fair value at that 5% premium at the end of 2024. Less than 10% of the time, going all the way back to 2010, had the market traded at that much of a premium or more. And then it actually traded a little bit higher in mid-January before the sell-off began. And what we noted to start off with is that sell-off really began with a bear market in artificial intelligence stocks. When we look at our valuations on AI stocks and those stocks most correlated to AI, we noted that by mid-January, they become at best fully valued. A lot of them trading slightly above our fair values, and a lot of them even in 2-star and 1-star territory, getting to be very overextended and overvalued. Once DeepSeek hit the headlines, I think that was the catalyst that caused investors to really start to reevaluate the valuations that they were paying, recalibrate what their expectations were for artificial intelligence going forward. And as you'll see in a few more slides, we've really had a tough bear market in those AI stocks, most of them falling well over 20%, some of them having even fallen 30 and 40%. And they've actually gotten to the point now where a lot of them have not only gone from 1 and 2-star rated to 3-star rated, but several of them actually now moving all the way down into 4-star territory and starting to look attractive at this point. But of course, you have to talk about the tariffs and how that's impacted the market over the past week and a half. And so while the first leg of the market really didn't have anything to do with the tariffs, it was really just a sell-off on those overvalued AI stocks, we've now seen it broaden out to the rest of the market where pretty much everything was down over the course of last week. Yesterday, the markets were relatively unchanged by the end of the day, even though we had huge intraday volatility. Market started off deep in the red from overnight futures, popped when there were some rumors out in the marketplace, and then sold off once those rumors were dispelled. Today, we have a very large pop in the marketplace. I really don't know why. I've been scouring the news, so really I don't know if it's much more of just short covering here in the short term, or if it's really just the beginning of a real rally because people have realized just how far valuations have gotten pulled down. But again, at this point with valuations where they are, I do think this is a good time to start overweighting stocks here in the U.S. Just taking a look at the Morningstar U.S. Market Index. So through last Friday, we were down 13.76 year to date. We were close to almost 20% sell-off from its highs in middle of January. Now, value stocks up until last week actually were in the green. They had been holding up very well in the face of the broad market sell-off, but like everything else, I think they were down 8% last week, taking us to negative 5%. Core stocks being down more than that, but of course, growth stocks with AI stocks being hit the hardest, being pushed down the most. And then the other thing to point out on this page is just going to be the performance of large cap versus small cap stocks. Now, in this case, I think it's interesting that small cap stocks have only underperformed large caps by a relatively small amount, less than 1%. Typically, I would expect that small cap stocks in a risk-off market like this would sell off more than large cap stocks. So I think there's probably two things going on kind of underneath the surface there. One, I think it's just a realization for people who are willing to dip their toe into the market today that they're seeing very undervalued levels in the small cap space. And then secondly, just the general expectation that small cap stocks being more domestically focused probably would have less impact from the tariffs on their business than we'd see in the large cap space. Then just looking at our fair valuations coming into the year as opposed to where they are now, really the biggest difference is going to be in that growth category. Coming into the year, growth stocks were trading at a 20% premium to a composite of our fair values, now trading at a discount. And I would just note that coming into the year, those growth stocks, that was really the highest premium that we'd seen in growth going all the way back to early 2021. If you remember at that point in time, we were in the midst of what I call the disruptive technology bubble. All of those disruptive tech stocks were reaching all-time highs. They were trading at just ridiculously high valuations. A lot of them were well, if not even higher than one-star territory. And of course, all came crashing down in 2021 and into 2022. Just taking a look at by sector, just noting that technology is the worst performing sector thus far this year, followed by communications. Again, it's for the most part really all of those AI stocks really hitting those sectors the hardest, but both of those sectors also selling off over the course of last week with that broad market sell-off as well. And generally, consumer cyclical, it's all about Tesla. Tesla being, I believe, the largest company by market cap within that sector. And again, Tesla skyrocketing after the presidential election, all the way through end of last year into this year. But I believe at this point, Tesla's down about 40% year to date. So in our view, it's gone from being well overvalued. I think it did touch, 1-star territory earlier this year. It is back to 3 stars. So again, consumer cyclicals starting to look a lot more attractive now that that premium has been taken out of the consumer cyclical sector. And then the more defensive sectors, as you would expect, holding up, to the best to the downside here. So seeing, better valuations, in those sectors as well. One thing to note when you look at an attribution analysis last year, we're all talking about how concentrated the market return was in, the top 10 returning stocks by attribution over the course of last year. So I'd note in the fall of the market this year, 7 of those 10 stocks last year are now the ones that are leading, the losses, to the downside. So we have those listed here by index weighting and the year-to-date return and their negative, contributions. At this point, you can see a lot of those stocks have gone from being overvalued, other than Microsoft and Alphabet, which are now even further undervalued, and a lot of these stocks going from 1-star to 3-star, or even 2-star and 3-star into 4-star territory. So we're now seeing a lot more interesting opportunities now that they have taken this pretty broad sell-off over the past couple of weeks. And then this time, taking a look at the attribution analysis, I would just note that pretty much all of those stocks that are in the green for this year that are helping bolster the market to the downside are pretty much either all value stocks, or at least they're stocks that are considered by the market to be defensive and in that value category. Taking a look at these stocks, most of them still in that fair value category at this point with 3 stars, a few like Coke and Berkshire moving a little bit into a 2-star territory. CVS being really the only one at this point that we still see some upside potential from there. And then lastly, just to finish up with this part, just showing a lot of these stocks that we think are most correlated with the AI trade, just how much these have fallen over the course of the year. A lot of these starting off the year in overvalued territory with 1 or 2 stars, and for the most part all going to 4 and 5 stars after the sell-off. Just taking a look at how value stocks have performed as compared to the broad market. So you can see at this point, over the past couple of weeks on a relative value basis, value stocks have been moving up towards what we think, the broad market valuation, is trading at. And a lot of this is really just due to more growth stocks on a valuation basis coming down as opposed to value stocks moving up. But at this point, we still see on a relative value as well as an absolute value basis, value stock category looking attractive. And then similarly for small caps, small caps on a relative value basis, not as undervalued as they were before. But again, that's just much more because large cap stocks have been coming down more than the valuations in the small cap space. But again, we still think small cap stocks look very attractive for investors today. Just moving on to our sector, our valuations, just taking a look at by sector, the percentage of stocks in each sector, coming into the year, is much more difficult to find undervalued opportunities. I believe is close to 25% of the market was 4 and 5 star rated. At this point, it's well over half the market. And then you can see by those sectors that have sold off the most and they're most undervalued where we see the most opportunities today. So at this point, communication services is the most undervalued sector, trading at a 32% discount. And that's really across pretty much the entire sector. So again, Alphabet and Meta are by market cap, the 2 largest, by market cap within the sector. I think they account for well over 40% of the market capitalization of the sector overall. Both those stocks have come down, look very attractive to us. But I'd note that even in the traditional communications and media space, we see a lot of opportunities in very strong, high-paying dividend stocks that have narrow and wide economic moats for investors to choose from as well. Some of the biggest differentials that we've seen thus far this year would be like the consumer cyclical sector. That's now dropped to a 17% discount. It started the year at a 19% premium. That was really all just due to the movement that we've seen in Tesla. but then technology has now fallen to a pretty deep discount at 22%. That started off the year overvalued at a 7% premium. Most of that being taking the air out of that AI bubble, but even more of your traditional technology names have fallen as well. Energy is a sector that we had recommended to overweight at the beginning of the year. It was actually doing very well for most of this year. It was in the green, I think, up until last week. And in fact, I think it was last Friday that the energy sector by itself sold off 8 or 9%. So now that has become even more undervalued, trading at almost a 20% discount to fair value. And the healthcare sector has also become more undervalued as well, dropping to a 12% discount from an 8% discount. But with healthcare, I'd also note that it's even more attractive than that. For example, we think Eli Lilly, which is one of the largest market cap stocks within that index, is significantly overvalued. I believe it's a 2-star rated stock, and that does skew that price to fair value higher. So if you were to take that out of our price to fair value calculation, healthcare becomes even further undervalued, dropping by a couple more percent. So at this point today, the only sectors that we actually still see as being overvalued are consumer, defensive, and utilities. Now, I would note utilities is pretty broadly overvalued across the board. Not a lot of individual name opportunities there. The independent power producers are specifically the most overvalued stocks within that category. They've been hit pretty hard, but we still think that they're overvalued and have further to fall from here. Then lastly, just to round it out here with the consumer defensive sector, this is what I consider to be more of a barbell valuation. So what we see there is the 3 largest stocks by market cap in that sector: Procter & Gamble, Costco, and Walmart. We think those 3 companies' stocks are overvalued. I believe Walmart and Costco are both 1-star rated stocks, Procter & Gamble being a 2-star rated stock. So if you were to take those 3 stocks out of our calculation, the rest of the consumer defensive sector looks very attractive to us. Some of the names that held up best this past quarter have been the tobacco names, the food names, stocks that we've had as 4 or 5-star rated. Also just good solid value stocks as well as high dividend paying stocks as well, that we see a lot of opportunities for investors in today's marketplace. I'm not going to run through all of these names. These are our sector directors' best picks by sector. International Flavors and Fragrances and Nutrien, both being new picks. Number of new financial services picks as well. Just to note here, by sector, technically Broadridge falls in the technology sector. Global Payments falls within the industrial sector, but they are covered by our financials analyst team, so that's why they're included in here. And then Federal Realty is a pick that's been in and out, a couple of times, just depending on its valuation, but makes a return appearance this quarter. A number of new picks, in the industrial sector. Adobe having gotten attractive enough to now make, one of our technology picks. And then lastly, Brown-Forman, Campbell's, 2 new picks to the consumer defensive sector. Pfizer being added in healthcare, and then Eversource Energy being added in the utilities sector. Taking a look by economic moat, moat stocks are looking really attractive here. In fact, they are now the most attractive part of the market. So at the beginning of the year, these were at best pretty fully valued, if not getting to be overvalued. The mega cap names like Apple, Alphabet, Amazon, Microsoft, Nvidia, all getting hit hard, very hard thus far this year, bringing valuations down to very undervalued levels in that large moat sector, but even the mid and the small also looking attractive, and seeing a lot of value among the moat names in the value category as well. So I do think now is a good time. Scour your portfolio and look for those areas where you can swap out of those companies that do not have an economic moat into those companies that we believe have long-term durable competitive advantages. And as always, I like to provide a screen. So using Microsoft tools, you can look for those companies. So in this case, I screen by large cap stocks with wide economic moats and either a medium or low uncertainty, and then just do a reverse ranking here from the most undervalued on up. Similar, doing the same thing for mid cap stocks. And then lastly, for small cap stocks. And then with small cap stocks, I just note here that there aren't enough small cap stocks with a wide economic moat to flush out this list. So in this case, I add narrow economic moat rated stocks as well. Taking a look at the mega cap stocks, And I'm just going to flip through these. People can come back later because I want to make sure I have enough time for Preston and Michael. But just looking at their performance, these are now the updated list of undervalued mega cap stocks. Some good, strong names coming into this list like Meta, Amazon, and Pepsi. And then here's the performance of those names that we identified at the beginning of the year as being overvalued mega cap stocks. Kind of a split decision here. Half of them have fallen, half of them have kind of held their gains. So again, a lot of these now having fallen out of the list and a couple new names coming into the list for the rest of the year. Then just to wrap things up with our fixed income outlook, bonds have held their own. We've actually seen a decline in long-term interest rates, so that's helped bolster the Morningstar Core Bond Index up well over 3% year to date. Now, we've been recommending for a while now to be underweight investment grade and high yield corporate bonds. And that's actually played out. What we've seen over the past couple of weeks is that corporate credit spreads that we thought were way too tight for the amount of risk that you take in investment grade and high yield have blown out over the past couple of weeks. High yield moving out 111 basis points to 438 over, and investment grade having widened 32 basis points to 111. I'm sorry, actually high yield widened 148 to 438. At this point, I still think that there's probably more downside risk than upside potential, so I still prefer U.S. Treasuries and structured finance bonds over the corporate credit risk at this point in time. And I didn't get a chance to update these slides, but I think just intuitively you can look and see where the corporate credit spread is for investment grade and high yield, and see that on the long-term basis, even with as much as we've widened over the past week, they're still at near historically tight levels for both of these indices. So with that, I'd like to turn the baton over to Preston to provide us with his updated economic outlook.
Thank you, Dave. So, needless to say, tariffs have radically altered our economic outlook, with tariff rates blasting up to levels not seen in a century. This will set in motion a cascade of supply and demand side shocks, all acting to weigh on the rate of economic growth. So we've reduced our real GDP forecast by 0.7 percentage points in 2025 and 0.9 percentage points in 2026. This is accompanied by some catch-up in 28 and 29, but there will be some permanent damage. So the level of real GDP in 2029 is still down by 1.1 percentage points compared with our prior forecast. Now, there's plenty of room for uncertainty. Our expected GDP growth rates skirt just above recessionary territory, but we do see the probability of a recession at around 40 to 45%. On the other hand, we could see more of a slow burn where the deleterious consequences of tariffs for economic efficiency steadily drag on growth over the next 5 to 10 years without provoking an abrupt slowdown. On inflation, the U.S. had nearly beaten back inflation. It dropped from 6.6% in 2022 to 2.5% in 2024, but tariffs will breathe new life into inflation, starting with goods prices, but likely flowing into the rest of the economy with a lag. Our inflation forecast rises by 0.6 percentage points in 2025 and 1.3 percentage points in 2026. And then after that, inflation should drop off as the slack created by very weak GDP growth creates some disinflationary pressure. So once all the tariffs announced as of April 2nd take effect, we estimate the average U.S. tariff rate will stand at a staggering 25.5%, up 23 percentage points from 2024. We expect the average tariff rate to still stand at a hefty 18% at the end of 2025. Now, some exemptions are likely, of course. There's little more that Trump relishes more than being in a position to dole out imperial favors. We could even see a total about face. Certainly rumors of that seem to be moving markets up this morning, the notion that maybe we'll see a substantial rollback of tariffs. But conversely, escalation is also possible, with retaliation following retaliation, with Trump having threatened to add another 50% tariff on China, which would amount to a de facto embargo. So look, we in our prior forecast, we got this wrong, frankly. Up until the last week, we had viewed tariff threats as largely saber rattling, designed to push through other geopolitical goals. This was the case during Trump's first administration, and for the first few months of his second term, this pattern continued to play out. Seemingly, tariffs were implemented on Canada and Mexico for a few days, but quickly rescinded after he deemed concessions had been made around border security and other issues. But, on April 2nd, Trump's rhetoric was purely mercantilist. That is, he is determined to use tariffs to quash the U.S. trade deficit and revive, thereby, the country's manufacturing dominance to its historic heights. And as he reminded us last week, he's harbored this vision since the 1980s. And crucially, in contrast to his first administration, he's now surrounded by personnel who bow to this vision. So we now think most likely high tariffs are here for the long haul. We see tariffs probably coming down only gradually over several years after the cumulative toll of economic pain and potential election losses compels a shift in policy. So, a normal recession is precipitated by an abrupt contraction in aggregate demand. 2008 is a classic example. But, like the recent pandemic recession, the tariff surge is really more of a mix of demand and supply side shocks. Now, the direct impact of the tariffs is a supply side shock, representing the hit to economic efficiency from cutting off foreign trade. In general, deviating from the free market equilibrium diminishes the productive capacity of the economy. But, unlike the pandemic shock, when people could eventually return to work, this hit to the supply side is permanent if the tariffs aren't removed. So there's really, in light of that permanence, no scope for counter-cyclical policy, whether fiscal or monetary, to offset the impact of such a permanent supply side shock. Aggregate demand will also contract. Partly this is because the tariffs represent a large tax increase hitting private sector incomes, unless the tariff revenue is totally recycled into new tax cuts and government spending. But perhaps the bigger demand side factor, though, is the surge in uncertainty that we're seeing and the associated deterioration in financial conditions, which could lead to firms and households cutting back their spending. Of course, uncertainty also exacerbates the supply side contraction. The lack of clarity makes it hard for businesses to plan and adapt to a new tariff regime. And so because of this, we may even see little domestic supply response to make up for lower foreign imports. So putting this all together, we expect the supply shocks to predominate. And that means that the net impact of the tariffs is moderately inflationary over the next couple of years. To the extent that this is wrong and the demand shocks outweigh the supply shocks, this could be much less inflationary and more recessionary. But one thing we do know is that the demand and the supply shocks will act in concert to reduce real GDP. Just to provide a little more historical perspective, the U.S. average tariff rate stood at about 2.5% in 2024. The first round of Trump tariffs back in 2018 or 2019 only increased the average tariff rate by about a percentage point. But again, with everything announced on April 2nd, the U.S. tariff rate will explode to about 25%, the highest in over a century, since 1905, in fact. And even our projected year-end 2026 tariff rate of 15% would be the highest since the 1930s. Now, the difference with back then is that the U.S. and global economy are vastly more interconnected now. U.S. imports as a share of GDP averaged 3.7% in the 1930s, but stood at 14% in 2024. So this is truly an unprecedented event. So, we know that very clearly that, Trump's agitation with tariffs stems from a longstanding grievance against the U.S. current account deficit. I'm going to use the terms current account deficit and trade deficit somewhat interchangeably. Technically, the current account deficit is the trade deficit plus the balance on foreign income flows. but the trade deficit is the primary driver. So I'll use these terms somewhat interchangeably. Now, what's interesting is that from an economic theory standpoint, the direct impact of tariffs is extremely unlikely to make a dent in the trade or current account deficit. So this is counterintuitive, but it's a logical consequence of basic accounting identities. That is, the current account deficit equals the net inflow of foreign capital. So because this is an accounting identity, it's not merely a theory, it holds with certitude. So if the flow of capital is inelastic with respect to the exchange rate, this is why the capital, this blue line on this chart is a vertical line, then an increase in tariffs cannot improve the current account deficit because what happens is the foreign exchange market reaches a new equilibrium by exchange rate appreciation and also some combination of retaliation from foreign countries, because if you have an increase in foreign tariff rates on U.S. exports, then that will obviously discourage U.S. exports and help and keep the current account deficit relatively unchanged from that perspective if imports and exports are both going down. But to the extent, even if retaliation is not anything like 100%, we would expect foreign exchange the U.S. dollar to appreciate to the exact degree required to keep the current account balance unchanged. This is if capital inflows do not shift, which as a base case, we wouldn't expect. So again, that's the only assumption we've made here is the inelasticity or lack of sensitivity of capital flows with respect to the exchange rate. Now, interestingly, we haven't seen appreciation in the U.S. dollar. The U.S. dollar actually is down 3% year to date. Now, partly this could be because markets are anticipating a very high degree of retaliation from U.S. trading partners. But I do think retaliation is unlikely to be measure for measure. So this lack of appreciation is something of a puzzle. And I think an explanation could be that the tariff chaos is so degrading confidence in U.S. markets that it's actually stemming the flow of capital into the U.S. So ironically, this contraction in capital flows could actually achieve Trump's goal of making a dent in the trade deficit, albeit not by his intended route and not by a route that is desirable for the U.S. economy by any means. Because while, a small measured reduction in capital flows into the U.S. could represent a healthy rebalancing of the global economy, a panic and sudden stop could have calamitous consequences. So, to the extent that we do get more exchange rate appreciation, that could blunt some of the inflationary ramifications of the tariffs, but we're not seeing that for now. Now, another factor that's going to mediate the inflationary consequences of the tariffs is what happens with fiscal policy. So right now, we're estimating that the tariff revenue in 2025 will amount to a fiscal contraction of about 1.8% of GDP. And we're only expecting that to be partially offset by new tax cuts and spending, because we had already included, extension of the TCGA, the 2017 TCGA in our baseline forecast. So the fact that that's proceeding is no change to our forecast. So tax cuts will probably only be enhanced slightly, just given that Congress has a lack of clarity around the permanence of these tariffs and the associated revenue. And so altogether, our expectation for the federal deficit has been reduced by 1.5% of GDP compared to our prior forecast, which is a substantial fiscal shock. Now, to the extent that we do get additional tax cuts coming from the tariff revenue, then that could better prop up near-term GDP growth, albeit at the cost of higher inflation. Just turning to some of the near-term data briefly. So it's likely that real GDP growth in the first quarter 2021 will be driven down by this jump in imports that we're seeing. The Atlanta Fed is projecting a 0.8% decline in real GDP for the first quarter of 2025. And sorry, the annotation on this top chart is incorrect. The GDP now projection refers not to the fourth quarter of 2024, but the first quarter of 2025. And so that nowcast is it shouldn't be taken as a signal that a recession is beginning right now, because the 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 projection that GDP will decline is driven by a fall in net exports, driven by a surge in imports, which is ultimately driven by companies racing to stock up on imported goods to the extent they can before tariffs go up. Now, actually, in principle, if you think about it, that should be fully offset by an increase in other components of GDP, whether that be inventories or other kinds of expenditures. Because you think about it, the goods, they come off the dock, they register as imports, and then they have to go to a warehouse. They have to go somewhere, and they should show up in terms of GDP in those other areas. But that offsetting impact isn't yet showing up owing to measurement error, which is why these quarter-to-quarter estimates can be so volatile because of that measurement error component. But it eventually will. So we'll eventually either see some upward revisions to the first quarter estimate if it turns out to be negative, or we'll see a rebound in the second quarter. So the recession isn't here yet, but we do see some of the underlying components of GDP also slowing. So it looks like real consumption growth is likely to slow to around 0.5 percentage point in the first quarter. Even prior to the tariffs, we had cited consumer exhaustion as likely to provoke a deceleration in growth in 2025. And now with the tariffs, we're expecting a very sharp slowdown in GDP growth. We think that the bottom in terms of year-over-year growth rates will come sometime between the fourth quarter of 2025 and the second quarter of 2026 at around 0 to 0.5%. If we were to get a negative reading year-over-year for real GDP growth, that would be unambiguously a recession. Although, again, it's a somewhat subjective decision-making process for declaring a recession. Labor markets, I won't go into this in detail unless you want to, but just going into today, or into the tariff announcements, labor markets had looked relatively in balance. Now, in terms of what we're expecting from the Fed, the market has altered its expectations for the federal funds rate a good deal. We've kept our expectations more or less unchanged. We're expecting 3 rate cuts this year, 3 rate cuts next year, and 2 rate cuts in 2027. So we're roughly in line with what the market's expecting right now. Obviously, I do see a chance that the primary impact of the tariffs is more recessionary, which would call for more aggressive Fed action. But again, there's that scenario I called out where we don't have a recession and we just have more of a slow stagflationary burn, which would call for more restrictive monetary policy. So balancing all that out, we haven't altered our trajectory for the federal funds rate a good deal. But on net, it does look like the federal funds rate will come down in order to support the economy and maintain healthy economic growth. So with that, I'm going to turn it over to Michael to continue the presentation.
Thank you. So from one bloodbath to another, looking at Europe. So I've been saying for a while now that Europe has been getting into better shape, certainly in comparison with the US. Our inflation rate was down, or is down, almost to the targeted level. Interest rates are down to 2.5%, the lowest in the Western world. And GDP growth, that gap between the US and Europe, has kind of slowly been narrowed. So, and if you add to this as well, the recently announced German infrastructure fund, it's going to add about 500 million euro into the German economy, which, to put that into perspective, the Inflation Reduction Act in the US was worth about $900 million and was spread out of a population of about 4 times the size of Germany. So a lot of positives happening in Europe. But that's the good news. And the bad news is all of that is out the window at the moment, with this tariff threat hanging over all of our heads ultimately. Should we, by some miracle, manage to get out of this kind of unscathed and this situation to kind of fix itself in the short term, then there's nothing to say we couldn't kind of resume that path of growth and improvement in Europe. The backdrop for European equities kind of outperformance at the beginning of this year. But like Preston mentioned, the longer this situation goes on, the more it gets baked into forecasts and the more damage we take as a result. So valuation now, how does Europe look? So this is the first time since I've been producing this report that we're really struggling to keep a pace with markets, or that market movements on a day-to-day basis are enough to shift the picture. And this number has indeed changed since we've gone to print. So the number now is about 0.87 for Europe. So that's saying there's about 15% upside from here. And that kind of changes the picture. That kind of puts us in perspective with the bargain territory that we've seen about 2 years ago. The real difference with markets now, though, is that there's a real threat, a direct threat that we all know about hanging over our heads that's causing this opportunity to arise. What's interesting is if we look at the performance of European equity markets, it's on the chart on the left-hand side here. European equity markets had been outperforming global equities and US equities indeed. Year to date, they still are, but the performance had been quite marked until a couple of weeks ago. Europe had been up around 10% year to date. And that's tailed off a little bit, as with other markets. It's taken some hit as a result. And that's kind of reflected in valuations. So the only good part of this is valuations have fallen and created even more opportunities for us. And again, this chart on the right-hand side has shifted downwards a little bit since we've gone to print on it. But the message remains that Europe has still got a lot of upside at the moment. It's still worth a look from an investment perspective. But relative to other markets, for example, like the US, there actually is a little bit more upside in these markets currently. Style boxes then, and we kind of paint a similar picture to the one that David talked about in the US. So obviously the general market is trading at a reasonable discount, and that's interesting for that reason alone. But if you dig a little deeper into value and mid cap and small cap, for instance, you're going to get a lot more upside, particularly with small cap in Europe. And I think the one difference I would point out between the US and Europe, and you can see it on this chart, is that the discrepancy between small cap and the general market, and then indeed mid cap and the general market, is even more marked in Europe than it is in the US. So you can get even more upside in those areas than we pointed out in the US, for instance. So what's happened in the first quarter, just trying to take stock of everything that's happened, especially over the last few weeks, and it's influenced those numbers too. So you can see I mentioned that the European market had at one stage been up 10%. Now that's tracked back to kind of more low to mid-single digit gains. But you can see that those movements over the last quarter have been there's been a large disparity between the sectors that have moved ultimately. So there's been a clear flight to safety, the likes of utilities, consumer defensives, financials to some degree as well has seen a large uptick over the last few weeks at the very, very least. And indeed, over the last 12 months as well, you've seen it kind of compounding some of those gains. So it's very much sector driven, certainly over the short and the longer term picture there. So that's what happened, but what's happening now? How do markets stand today? And if you're looking at Europe, which sectors should you be looking at? So the good news is there's not a single sector in Europe that's currently overvalued. But if you look at if you want the cheapest sectors in Europe, certainly for those brave enough amongst us to invest, you can see consumer discretionary is offering a whopping 30% plus upside from here. And then that's followed by the likes of tech and indeed healthcare in Europe as well, which are still offering 25% upside. So some good value to be had within those sectors as well. For those more defensive minded of you, and this is kind of one of the key differences I'd point out from some of the charts that David presented earlier as well, the defensive sectors in Europe are actually still offering pretty good value as well. So if you look at consumer defensives, for instance, and indeed utilities, despite those gains that I mentioned that they've attracted over the last quarter and indeed the last year, those sectors are still pretty attractive at this point. There's pretty decent upside potential from there. If you want to go even deeper into that, into terms of stocks, on the consumer discretionary side, home builders are obviously very attractive at the moment, being dragged down by the fears for the general economy. Luxury names, Kering, the owner of Gucci, for instance, there's quite a handful of luxury good stocks in Europe that are offering pretty good value at the moment. And it's our view, or the view of the analysts, that these stocks are more price immune than the market is giving them credit for. And then further down that list is indeed autos. So the very front line of tariffs within Europe, the likes of Volkswagen, BMW, etc. All of those stocks are flashing up as very attractive at the moment. And again, it's our analyst contention that there's sufficient upside despite all those fears that you can invest safely in those stocks with a view to the long term. Consumer staples then, brewers, for instance, Heineken, tobacco stocks, British American Tobacco, and then on the kind of more consumer staple side, household goods side, the likes of Reckitt Benckiser, another UK stock. I'll give you one more just in healthcare then, because I mentioned it, the likes of GSK has recently come into kind of contention for an attractive name as well, but there's a lot more to come where that came from. And a shameless plug for our webinar as well. If you want to hear more about Europe and what's going on there, we have a webinar this Thursday where we'll discuss it in more detail. And on that, I'm going to hand over because I believe there are a ton of questions awaiting our attention.
Yes, we're going to get rolling on those. So we'll move on to the Q&A. So please submit your questions using the Ask a Question tab. And as you're typing your questions, as Michael mentioned, he and his colleagues have a webcast coming up. You can register for that webcast via the Attachments tab at the bottom of the screen. I'd also like to remind viewers that the Morningstar Investment Conference is coming up. It'll be held on June 25th and 26th at Chicago's Navy Pier. You can join Morningstar leaders and researchers, as well as industry experts, as they discuss topics that are top of mind for advisors and their clients today. You find more information in the Attachments tab at the bottom of the screen. And in that same tab, you'll find a link to The Morning Filter, which is a podcast that Dave Sequeira and I stream every Monday. Tune in each week to get Dave's take on the week ahead and find out about some new research at Morningstar. All right, let's proceed to our first question. Dave, we will start with you. We had a couple questions come in about how undervalued small cap stocks, specifically small value, but there's some interest in small caps in general, how they look so undervalued, yet they haven't participated in this year's market rotation that we've seen. So what would it take for small cap stocks to turn around?
Yeah, and I think you always have to kind of divorce in your own mind the difference between valuation and trading. So in this case, this is not necessarily a timing tool. We're just looking at the valuation on a long-term intrinsic value basis. So I think it'd be good for our viewers to go back towards one of those earlier slides where I show where small caps on a valuation basis have traded versus the broad market. Can see where historically they have traded above the broad market and how much they have sold off the past couple of years and before they bottomed out. So I think historically when you look at small cap stocks, they tend to do well in an environment where the Fed is easing monetary policy, long-term interest rates are coming down, and the economy is coming from a point where it's either in a recession and it looks like it's starting to reaccelerate, or maybe at least it had slowed down and looks like it's starting to reaccelerate. And unfortunately, I just don't think we're in that place right now. I think monetary policy, while we expect the Fed funds to come down, I think that's going to be especially cloudy as we go through all of the tariff negotiations and the Fed tries to understand exactly what's going on with the rate of growth in the economy versus inflation and which one they may target. Long-term interest rates are coming down, but really that's just been a flight to safety trade, more than anything else, which is usually not good news for small cap stocks. So I think this is one of those ones where, to some degree, I think they look very undervalued. They may stay undervalued, and it may be at least a couple of quarters until we get to the point where the market's going to start pricing in a reacceleration in the economy into next year, and then also have a much better understanding over the next couple of months exactly what the Federal Reserve is going to do. So again, this is not necessarily a short-term trade that we think is going to work out, but we think that for investors that you're going to be well positioned over the long term in small cap stocks. But again, also moving back to a market weight position in large caps as well, and then moving to that underweight into the mid cap stocks.
All righty. All right, Michael, the next question is for you. Are there any specific markets in Europe that are particularly attractive or particularly overheated from a valuation perspective today?
So the good news is that there's no sector or kind of area within Europe that's overvalued at the moment, which is a pretty rare occurrence, especially from what we've seen for the last few months. is there any kind of where to hide or where to track it from your that perspective? I think it depends on your level of bravery and your level of confidence in the current market recovery, and if indeed we're going to hit a recovery anytime soon, which ultimately is a possibility. So I think I pointed out consumer as a couple of good examples, like consumer discretionary, for instance. There's a ton of stocks within there that are offering probably the most upside of anywhere in Europe at the moment. So if indeed you're willing to kind of put your money on the line there, and embrace kind of short-term volatility that may come over the next few months, then the long-term payback is definitely going to be worth it. If you're a little bit more risk reverse and not willing to kind of take that pain over the shorter term, things that I find interesting, certainly healthcare stocks, you've got a pretty good defensive sector there. A lot of names, I mentioned GSK, pay dividends in the meantime. And they're relatively immune, excuse the pun, from the kind of global occurrences at the moment, especially most of these companies that produce within the regions that they're selling. So a lot of opportunities within that sector, also, I would say.
All righty, Preston, we have a question in about your tariff impact on GDP. Specifically, is your estimated tariff impact on GDP forecast, does it include the possibility tariffs are being used as a negotiating tactic?
Yeah, since I had a lot of slides to cover, I just want to remind everyone of this one here. So yeah, I am baking in some possibility of tariff rates coming down a good deal over the next few years. Indeed, by the end of this year, I do expect them to go from 25% to 18%. So some possibility that, yeah, this blows over, thanks to, negotiating wins, so-called, or, there's some possibility that they stick around or even go higher owing to escalation. So all those possibilities have to be weighed in. But I mean, again, in the past, I was weighting the negotiation story very, very highly. That was my overwhelmingly dominant scenario that I had priced in my economic forecast. So the reason why I'm more skeptical about that now is just looking at the focus on the trade deficit. I mean, how did they calculate those reciprocal tariff rates that were shown on that big placard on April 2nd? They literally just looked at the the trade balance divided by imports, and that was the so-called foreign tariff rate on the U.S. Assuming that ipso facto a trade deficit is evidence of trade barriers. So how do foreign countries negotiate to remove fictitious trade barriers? I mean, I don't even understand how that negotiation takes place. So, it's not clear to me what they're looking for concretely right now. In contrast to Canada and Mexico, where there were issues around border enforcement that could be addressed. I don't see really any path to de-escalation right now other than just Trump changing his mind, which could happen.
All right. All right, Dave, this one's for you. Aside from Morningstar, no one I've read feels the market is undervalued, certainly not in the US. So whether viewed on a PE or CAPE or Buffett ratio, what is Morningstar seeing that no one else is?
Well, Susan, that's quite a loaded question there you've got for me. So again, I think this just is really, evident of the difference in how we look at the market versus how I think a lot of other people look at the market. So again, we take that bottoms up approach, use a composite of all the intrinsic valuations of those, stocks that we cover, compare that to where they're actually trading, in the marketplace. And to some degree, you know what? I'm not a big fan of PE ratios at the market level. I'm certainly not a fan of looking at book values. I think book values are mostly just accounting fiction. And when I think about the market dynamics today, looking at the mega cap stocks that really skew the market one way or the other based on their valuations, I don't think that those companies have the same kind of valuation dynamics that you would have had 20 years ago, 30 years ago with who would have been the largest market cap companies. At that point in time, we are certainly much more concentrated today. So I don't think it's realistic looking at historical PE ratios and trying to compare those to what PE ratios should be today. And if you go to one of those earliest charts that show what our valuation has been going back to 2010, I'll just let that speak for itself. If you're listening to other market commentators out there, were they telling you that the market was trading at a pretty rare premium coming into this year, or were they still saying the market was undervalued? If I look back into 2022, I think we were probably one of the only shops out there that were telling people to underweight the market. As we expect, 4 different factors to weigh on the market in 2022. Back then we were forecasting inflation to increase. We were expecting interest rates to go up. We were looking for the Fed to tighten monetary policy. We were looking for a slowing rate of economic growth. All of that played out in 2022. And were those same commentators then telling you to overweight stocks in October of 2022? So again, I'll let our track record speak for ourselves on that one.
All right, Dave, I got another one for you. No rest for the weary. Can you elaborate a bit more on your thoughts regarding fixed income positioning for the remainder of 2025? As I understand it, you are looking more favorably at U.S. Treasuries versus corporate bonds.
Yeah, in my own mind, I still much prefer being in treasuries. So here I'm using Preston's forecast for long-term interest rates. So while we've had a pretty good run thus far this year, over the next couple of years, we're still looking for long-term interest rates to come down over time. So I think you capture both the yield carry as well as price appreciation for the foreseeable future. But when I look at the corporate credit markets, I still don't think you're getting paid enough in that corporate credit spread to account for both downgrade and default risk, especially now that we're looking for a slower rate of growth and having a much higher probability of a recession here in the United States. So I'd expect to see additional downgrades over the course of the year, and depending on how long that may go on, potentially an increase in the default rate in 2026. So I would expect to see corporate credit spreads continue to widen from here to be able to account for those additional risks. So I continue to maintain my recommendation to stay overweight in longer duration bonds, but remain in U.S. Treasuries.
Okay. All right, Preston, I'm going to give this one to you because Dave needs a little bit of break. Have these macroeconomic factors been priced into Morningstar's stock pricing methodology? I'm unclear on how Morningstar links macro events to equity ratings.
Yeah, I'm sure Dave will want to comment as well, but I have a unique vantage point because prior to being becoming U.S. economist, I was the equity analyst for oilfield services stocks for 5 years. So I've been on both sides of the fence. And what I can tell you is that, if you go back to the beginning of my presentation, I said that, the long-term GDP hit would be about 1% from these tariffs based off what we're baking into our forecast. So if you think about it, a 1% hit to tariffs means or a 1% hit to long run GDP means a roughly, as a first guess, 1% hit to long-term cash flows from companies. So, is the sell-off that we're seeing proportionate to that? No. I mean, which is not surprising. Cash flows will decrease in the short run, but not permanently. What happens in a recession, if you think about any asset pricing model, you have cash flows in the numerator and a discount rate in the denominator. And a recession is really about that discount rate blowing up. And that brings down the valuation or the short-term prices of equities and other risky assets. But here at Morningstar, we don't increase our discount rate during a recession because we're about the long run. And so that's why, ultimately, you're just not going to see fair values come down to the degree that, in any case, to the degree to which prices are falling in the market. So there is definitely, there's synchrony from that respect between our economic forecasts and the methodology that our equity analysts use, I think.
Okay. All right, Dave, back to you. If Morningstar thinks the sell-off started with DeepSeek and not tariffs, why is the sell-off broad-based, spread across sectors and asset classes and not only AI stocks?
Well, I think you have to look at the sell-off maybe in 2 different parts. So the sell-off, really began, in mid-January, maybe later January, and the stocks that got hit first and hardest were those stocks that were most correlated to AI trades. So those are the ones that we saw sell off first. The rest of the market, especially value stocks, were holding in, relatively well at that point in time. In fact, if you go to Morningstar.com, you can read John Reckenthaler's article that he published a couple of weeks ago, who kind of also went into his own views as far as why he thought that first part of the sell-off was really much more of a risk-off trade spurred by artificial intelligence selling off than it was necessarily the tariffs. But when we look at how the market's reacted over the past 2 weeks or so, we've seen how that market sell-off has gone from really just being preponderantly in the tech sector and the communications sector, Meta and Alphabet specifically, has broadened out across the entire market. So really bringing valuations down across all stocks, not just that small handful of stocks that have really been most tied to the AI trade. Value stocks also coming down as well as people are pricing in a much higher probability of a recession from the tariffs. So again, I think you need to break it down to not necessarily where we are today versus the beginning of the year, but really look at that sell-off as really having come in 2 waves.
All right. Well, we're going to take this a little longer than we should because we have a couple more questions we'd like to get to. So Michael, one for you. The defense industry stocks have skyrocketed lately. Is that industry now overvalued in your opinion?
So the short answer is no, Susan. I had actually planned to talk a lot about defense this week because we just kind of put out a few reports on the topic and raised a lot of our fair values. And then all of the tariff situation happened, and I think defense stocks in Europe have kind of been lost in the haze. But we haven't changed our fair value estimates. We think these stocks are going to be relatively unaffected by the tariff situation, and it's our long-term view that defense is, more than a flash in the pan. This is something that's going to last a while. And just to throw out a quick stat on that, Germany, for instance, we think even if the Ukraine war stopped tomorrow, a topic we've all stopped talking about, that it would take 10 years for the country to actually restock all the weapons that it's already given to Ukraine. So we think defense has a long way to go in Europe still.
Okay. Preston, do you see any possibility of U.S. inflation shooting up or being more persistent, forcing the Fed to hike again this year?
Yeah, I don't know about hike, but the market now is baking in at least another 5 or maybe 6 rate cuts. That could be off the table if the trade shock, a tariff shock is more inflationary. And by more inflationary, I mean, the economy avoids a recession. There is some slowdown in growth, but there's no sign of an imminent collapse. So, if equity prices don't fall off a cliff and if the government steps in and adds more fiscal stimulus, maybe recycling that tariff revenue in the form of stimulus checks or dividends or whatever they want to call them. Maybe that supports the demand side of the economy and creates more inflationary upside, less recessionary downside, and that could call for the Fed keeping rates unchanged for the next 12 to 18 months potentially until, the inflation starts to roll off. So I would say that's a credible possibility. Probably not going to see outright hikes, but you can't rule it out, certainly. We don't really know what the consequences of trying to unravel the global trading system and move to a domestic trading system would be. So, under the worst case for tariffs and we go down that road, I'd say, all bets are off.
Okay, following up on that one, Preston. Question is, does the trade deficit take into consideration services, technology, banking, etc.?
Yes. So the trade deficit for all goods and services is about 3% of GDP for the U.S. For just goods, excluding services, it's about 4%. So the U.S. has a trade surplus in services of about 1% that offsets the deficit in goods. And this is important because this services surplus has grown in recent decades. Other items that have grown have been the balance in oil and gas, which has gone from a near 2% deficit as a share of GDP in the 2000s to positive territory thanks to the U.S. shale boom. And also, another part of the current account is U.S. multinationals' foreign earnings, which have gone up by about a percentage point over the last 20 years. So all of those factors have, have compelled a large deterioration in the balance for goods excluding oil and gas. So basically the manufacturing sector. So you could almost kind of turn this all on its head and say, it's not foreign countries to blame for U.S. manufacturing's woes in recent years, to the extent those exist. It's actually, you could just as well blame the services sector. You could blame the shale boom. You could also blame U.S. multinational success, which increases the amount of foreign earnings. So all of those have been factors which have kept the U.S. dollar stronger than it otherwise would be, and thereby diminished the competitiveness of U.S. manufacturing.
All right. Last question. This one's a crystal ball question for you, Dave. Lucky guy. All right. So the viewer is saying that stocks are up today, and I just checked, they still are for now. Does that mean we've hit the bottom?
I'll give you a direct answer. I have no idea. No, I mean, in all realistic, no one can really call necessarily an individual market bottom. My own personal preference for investing, is to be able to scale in and scale out of positions, based on valuation. Again, valuations are not timing tools. Those are two different, aspects of investing. In this case, I think the markets have fallen far enough, fast enough, and gotten to valuations that are low enough that you can start moving into an overweight position here. Having said that, I think over the next weeks, months, we will still have a lot of market volatility based on news and rumors, as it comes out, as far as what negotiations are going on, who we're negotiating with, leaks as far as what the terms of those negotiations may be. So I think we'll see a lot of volatility. I think you move into a small overweight position here today, but then make sure you have enough dry powder that if we do have additional sell-offs, that you can dollar cost average in to the downside. Pick a couple of individual targeted areas, whether it's down another 3% or another 5% from where you made your last buy, and then you have to have the wherewithal to go ahead, reevaluate the situation, and assuming things and valuations still look the same, make sure you go ahead and buy to the downside, until you get to that full overweight position. But again, I would scale in to the downside. And similarly, if we do have, some really strong rip-roaring rallies, then you can take that small overweight position, lock in your gains and move back to that market weight.
Yeah,
All
I
right.
just want to piggyback on that. So I think it's always important to remember that bear market rallies are a thing. So it's not time to breathe a sigh of relief. And I have this stat handy right here. So between the market crash in 1929 and the bottom in June 1932, there were 8 trading days when the S&P 500 rallied by 8% or more in the midst of that long decline. So it's not over yet, even though stocks are rebounding a little bit today, potentially.
Yeah, there's always a lot of technical factors that will impact where stocks trade on any one individual day, which is why we as long-term investors are looking more at valuations than we are necessarily trying to time the market on an individual daily basis.
All right. Well, we will end there. I'd like to thank Dave, Preston, and Michael for their time today, and thank everyone for joining Morningstar's second quarter 2025 U.S. Stock Market Outlook webinar. Now be sure to check the attachments tab at the bottom of the screen to register for Michael's upcoming webinar and for the annual Morningstar Investment Conference. We'll see you next time.